One of the questions so many investors ask me is, what do I do in those awful moments when the stock market suddenly drops? And it can drop by as much as 30%. How do I manage that? Because it's going to wipe out such a chunk of my wealth. And you know what? So many of them then say, I'm so afraid of these sharp declines in the stock markets, I'm just not going to invest in equity. It's just too risky for me. Then they put their money in bank deposits. They put their money entirely in bonds. And you can see that over the long term, bonds and bank deposits simply do not perform as well as equity. And therefore, they're missing out on great returns for their retirement portfolio. What I want to do in this video is really help you allay some of those fears that you might experience about a market suddenly dropping by as much as 30%. There are things that you can do to manage those losses. There are some actions you can take that will mitigate those losses. But if you're going to do that, it's important to have a plan even before you start investing over how you would manage your way through this. So by the time you've watched this video, I hope you'll have a better understanding of why markets can drop so much, and most importantly, how you can think your way through such sudden drops and feel more comfortable that over the long term, you can benefit from those attractive returns that you get in the equity markets without having that enormous fear of a 30% wipeout in your equity holdings. Now, I've been in the markets over 30 years, and I remember the first time I saw a drop was when I was a graduate trainee at an investment bank, and I saw the Dow dropping so sharply. This was back in 1987, and it was an absolutely awful experience. Since then, I've seen many sharp drops as well, and I've learned there are certain hallmarks of these sell-offs in the equity markets and certain things that you can consistently do which will help you mitigate this risk. Now, the most important thing to remember is that you must have a plan. Don't wait until the markets sell off and then figure out what you're going to do, because chances are at that point you're going to be in panic and you won't be making the best decisions. So have a plan from the get-go as to what course of action you would take if things start to go wrong. It's all about process and all about planning. So this video is going to focus very, very heavily on that type of process and planning that you need for the day when you want to hit the panic button or hit the sell button. Now, just before I begin, as ever, please, if you like this video, do click the like button, do click subscribe, because it helps other people to find these videos as well. If there's anything in a video you don't understand, feel free to stick comments below and I'll come back to you and answer them. If not, there's a link to my website on the description below. When you see that, you can go to the website, there is a help forum there, and you can also click there to arrange an appointment to have a chat with me if you find that will be helpful. So don't let yourself get stuck if any of the material is at all complicated. There's always going to be someone around to give you some help there. Start again. So let's begin by looking at why markets can suddenly sell off and why an inexperienced investor can suddenly start to panic. Or frankly, let's also say that a lot of experienced investors will also start to panic during these sell-offs in the equity market. Essentially, there are three reasons why this might happen. The first is that there is some existential event that you could not have possibly hoped to forecast that suddenly happens, and the markets really don't like it, and they fall really, really sharply. The best example of that I can think of is when the COVID pandemic hit. I don't think any of us would have forecast that event, although we know typically that pandemics can hit about every 100 years or so. There's no reason to believe that one was going to hit at that particular time. And therefore, there's no point in beating yourself up and thinking, I should have forecast this, I should have made arrangements. You couldn't have forecast this. It's just very bad luck. But these events will happen. There will be, for example, wars, and these will suddenly drag markets down. Don't panic. You can't possibly hold yourself to blame, but you need to have a strategy for dealing with them. Now, the second type of event is usually one that you'd actually sort of forecast, or you sort of thought, well, maybe it will happen, but you had assigned a very low probability to that event. So although it had been in the back of your mind somewhere, you thought this probably isn't going to happen, and your portfolio does not reflect, therefore, the possibility of that eventuality actually occurring. Again, don't beat yourself up, because you can't get it right the whole time, and also you can't prepare for every very low probability event. Now, some people will say, for example, the financial crisis, that you could have forecast it. And indeed, there were people who did. But so many people thought, wrongly, that it was going to be a very low probability event, and therefore they didn't factor it into their portfolios. So that's the second reason. It's something that we'd known about, but we thought it wouldn't happen. The last reason is that you just got it wrong, that there were good reasons for believing the market might actually sell off sharply, and that for whatever reason, you had decided that wasn't going to happen. Your equity portfolio was long, and as a result, you're losing money. Once again, don't beat yourself up about it. We all make mistakes. Forecasting financial markets is not an exact science, and therefore there will be times when you have a view which is totally wrong. You still need, however, to have a good process to dealing with what happens when you get it totally wrong. So those are the three reasons: an existential drop in the financial markets that you hadn't possibly forecast, something that you had thought might happen but you decided a really low probability, and the third one, you just got it totally wrong. Let's now delve a bit further into what kind of actions you might want to take. Now, the most important thing, and I realise I've already said this, but I'm just going to reiterate it, is don't panic. You need to go through a very robust decision-making process. And the first question you have to ask yourself is this just a regular type of fall in the market, which might be 5%, possibly as much as 10%, which I can think I can weather, and therefore I'm not going to start to unwind my portfolio? Or is this a big drop, 20%, 30%? Now, of course, that may be the first question you need to ask yourself, but it's probably the most important question, and it's very, very difficult to answer. Each financial market sell-off is different. But what I can do is I can give you a couple of thoughts on things you might look at, which will give you a sense of whether this is just a small sell-off, or it's something which is longer, that may go on for months, or it's going to be very, very sharp indeed. So here's the first couple of things that I strongly recommend you look at. The first is try to understand technical analysis of the market. Now, what technical analysis means is there is a group of people out there who study the charts of market movements. One of the things they uncover is there are certain support levels for the market, they're called. A support level is where the market's going to do one of two things. Either it's going to bounce off the support level and keep on going up, or it's going to break through. And the fact it's broken through means it's going to go downwards to the next support level. Having a knowledge of these support levels is absolutely critical. And what's most important is understand what the key support levels are for the market that you're looking at. Now, these change all the time. It might be the 50-day moving average, it might be the 500-day moving average. It might alternatively be a level where the market spent a lot of time trading before finally it broke through that level and then traded higher. Either way, you can find out what these key support levels are, because there's a lot of market commentators who opine on this, and you can easily find them on the internet. I watch them very, very carefully, because if the market breaks through what people think is a key support level, then chances are it may be going a whole lot lower. Now, the reason why this is really important is the commentators will typically distinguish between minor support levels and major support levels. You really want to get your head around those major support levels. Keep an eye on them when the market's falling, and if it gets through one of those levels, you know you need to act. Another possible conclusion as well is that if you think the market's really going to drop, if it gets through one of those levels, you may want to think, what would I do on the approach to a key support level? Do I start wanting to reduce my position as I approach that level? Again, although you'll have to decide at the time, I think it's an important process to have already prepared. Know where to look to find the important support levels, know which commentators have given reliable advice in the past, and make sure you've got those pages bookmarked and ready to look at. Now, another thing you can consider is that you've really got to recognise what is a bull market and what is a bear market. So one of the things that I've always looked at is a bull market is one which typically just goes up under its own momentum. If you get some bad news out, it still goes up. A bear market is one that's going down on its own momentum, and chances are if you get some good news, it still goes down. I always look at how the market reacts to major news releases. And if you start to see some good news coming up and the market just goes up briefly, maybe for a day, and then it starts falling again, that tells you the path of least resistance is to go lower. So it's important to have in your mind almost a picture of whether you think you're in a bull phase, a neutral phase, or worst case, a bear phase, and under what conditions you would change your mind. Also, look at the calendar of economic releases. Look at those releases and you can see whether the market's going up on good news or whether it's going up on bad news, and see how it's likely to react. If you consistently see it dropping, even though some news comes out that you think should be good, then you're probably in a bear market. So to recap, the first decision you need to make is to actually recognise, is the bull market or that neutral phase of the market over, and you're now in a set of circumstances which is either a prolonged bear market or alternatively a very sharp drop, which could be of magnitude of 20-25%, where you need to take some action. This is really important because clearly you don't want to be pushing the sell button every time the market drops 1%. You don't even want to be panicking your way out of positions if the market drops a few percent. You need to consider, what is the magnitude of move which is sufficiently great that it will cause you to be concerned about your own portfolio, your own financial future and act accordingly. And only you know that number. For some investors, it's going to be a much higher number than others. But you've got to have that in your head. How much of a loss can I sustain before I'll start to unwind? Let's now move on to some worked examples of things that you can do to reduce the risk on your portfolio once you've suddenly seen the market is dropping rapidly. So in other words, you've been through the technical analysis, you've had a look at the fundamentals, and you've now decided what we're seeing at the moment is the possibility of a major drop, let's say 30% in the equity markets. Let's now work through what course of action we might possibly take. So let's look at a rather lucky investor here. This is a guy who's got an investment portfolio of just north of $3 million. Let's say he's working, so he doesn't actually keep a lot of cash there. You can see the amount of cash he's sitting on is very, very small. And he's quite young as well, so quite prudently, he's got most of his money sitting in the equity markets. Around 83% of it is sitting in the equity market. And this is how his portfolio is currently structured. He's got nothing in fixed income, which means that he's clearly not thinking there's going to be a recession anytime soon. He's pretty optimistic about the state of the economy. And let's say something goes badly wrong out there that he had not possibly foreseen. So we can now, as the next step, try and stress test his portfolio against what will happen for a big drop in financial markets. So by stress test, I mean really trying to understand how a big change in the markets will impact his total wealth. So let's now have a look what happens when we apply the stress test. So this is how we're going to stress test the portfolio. I'm going to impose some losses on his equity portfolio. I'm going to impose some losses on his property portfolio. The losses on property are slightly smaller in this particular case. The reason I think why they're slightly smaller is partly because property is a much less liquid asset class, so it takes longer for the losses to be apparent. And also I'm going to assume that the jurisdiction he lives in where he's bought property, the property market is perhaps rather more robust than the equity market. So to make his life a bit more comfortable, we'll put in some smaller losses for that. We'll put in some gains for the fixed income portfolio, because fixed income, of course, if you're holding government bonds, that normally performs better in a recession because there's a flight to quality and interest rates are more likely to come down. And we'll put in a small gain for his bank balance because, of course, he's getting interest on that. So these are the numbers of the stress test that I think I'm going to impose. And you can see it looks on the face of it pretty dire, where the biggest chunk of his portfolio, which is equity, is going to take probably the biggest hit. And the one part of his portfolio that is relatively secure, cash in the bank, it isn't really going to make him very much money. So the next step now is to see what happens to his assets once we've imposed those changes in the valuation on them. And here now on this new spreadsheet, you can see what's happened to his overall wealth. It's not a great picture. He's down 26%. This isn't good. At least it's better than being down 30%. And that's because the property market hasn't performed so badly and because he's made a tiny little bit of money on his bank balance. So this is the example of the investor who does nothing. This is the investor who either hasn't realized the market's fallen because he's too busy doing something else and therefore he's just ignored his portfolio, or the markets have been falling and he's decided he's going to do absolutely nothing about it. And there are investors, believe me, who decide under such severe circumstances that they will do absolutely nothing about it. Or possibly he's the investor who only thought it would be a 5% drop, and at 5% he thought, well, maybe it's only be a 10% drop, so there'll be another 5% from here. And every day goes by, he loses a bit more money, and he keeps thinking that you're at the end of the sell-off. He's not looking at the technical picture. He's not looking at the fundamentals. He's just been caught out by a big sell-off. Happens to a lot of people. So although it sounds really, really stupid, actually, a lot of very smart people get caught out this way. And as I said before, don't beat yourself up too much if it happens to you as well, because decisions are not so easy to make when you're in the thick of a financial market which is moving very, very rapidly. But anyway, here you go. This is what his portfolio looks like. Let's now consider an alternative investor. And this alternative investor, he saw the market start to fall. He had certain thresholds in place where he decided if it fell by that amount, he would start to reduce his risk. And let's see what he's done to reduce his risk. So here I'm going to show you the investor's new portfolio. This is the portfolio where he's decided that the market's crossed various thresholds. It's got through some major support levels. He doesn't like the fundamentals. He's concerned about a recession, and he's traded quite actively to get that equity position down. So this is what it now looks like. To give you an example of what the old one looked like, I'm showing you the old portfolio in grey, where he has, of course, the much bigger weighting towards equity. What are the main things he's done? First and most importantly, he's got the equity positioning down. Second, what he's done, which is very clever, he's realised that if he thinks there's going to be a recession, the type of market which will perform best in a recession is going to be something like government bonds. So he's moved a lot of his assets into government bonds. He's obviously very uncertain about the environment, so he's also keeping a lot of cash there as well. So a lot of his money is now capital protected, at least from market movements, by stuffing it in the bank. Bear in mind, as ever, that if you look at the size of his assets in the bank, that's probably over any insurance limit a government is going to give you. So you certainly don't want your bank to go bust, or that's going to leave you exposed as well. But anyway, for the time being, that's what he's done. He's taken a big chunk out of equity, moved it into government bonds, and has left the rest in the bank. His property portfolio is broadly unchanged. So let's now impose the same stress tests on his new, more conservative portfolio and see how he's performed. Well, straight away you can see he's lost money as well, and this isn't great. This isn't ideal. No one wants to lose money. But you can see that compared to the 26% loss which he would have experienced had he done absolutely nothing, this is a much milder loss. This is something which is much easier to stomach. And of course, as the equity markets sell off, he may have the opportunity to buy that equity back cheaper in a few weeks or few months' time. So this is a clear illustration of an investor who, having realized the market has passed certain key thresholds, has scaled back his position, has managed to mitigate a lot of the losses, and also given himself a fair bit of cash in the bank that he can start to use to buy equity cheaply, ready for the next bull market swing when it comes around, maybe in a few months' time. Now, this is a very stylized example. We've only used a very limited number of asset classes, and clearly the investor has taken a very simple strategy. He's basically bought some fixed income and he's put the rest of the money in the bank. What I want to share with you now is some of the alternative strategies you can look at to get that equity risk down. And essentially there's 4 of them you can look at. Now the first one is just put cash in the bank. Now the main risk with that strategy, as I mentioned earlier, is that banks themselves can become vulnerable in downturns, particularly in a serious recession. So you want to be careful that although in terms of your normal daily mark to market, you would hope to feel comfortable, you're out of all market risk. If you don't know what's going on, chances are your portfolio value is not really going to change much from day to day. That's the good news. The bad news, of course, major recession, your bank goes bust, you'll lose anything in excess of the insurance limits. So bear that one in mind in terms of keeping money all in one bank. At least if you diversify, that might be a better strategy. The second one, which our investor also used, is to put money in an asset class which is reverse correlated with equity. And in this case, he bought fixed income bonds. Now, fixed income government bonds are not always reverse correlated with equity. Sometimes they move in the same direction as the equity markets. But our investor took the view that as this was a recession coming, he thought there'll be a flight to quality. Interest rates might come down as governments ease monetary policy, and as a result, that could precipitate a rally in the government bond market. And therefore, in this particular stage of the economic cycle, you would see that reverse correlation. And that's why switching from equity to government bonds under these particular circumstances was a very good idea. Now, that won't always be the case. There will be times when the markets are selling off for a different reason, and maybe government bonds might not be the right place to be. Certainly, if you're around during the sovereign debt crisis, for certain government bond markets, that would not have been a great strategy. For others, it would have very nicely indeed. So give that matter some thought if you can as to whether government bonds are the right place to be. Now, a third strategy to consider are bear ETFs. You can sell some of your equity, and with the equity you've sold, you can buy a bear ETF. Now, what a bear ETF does is it basically makes money when the stock market goes down. You can even get leveraged bear ETFs, which will make you twice as much money or 3 times as much money when the stock market goes down. Effectively, this enables you to have a hedge, that you may have a whole load of single name stocks that you own. You don't want to sell them because the trading cost of selling 100 line items is going to be quite high, and you still fundamentally believe in those companies. And therefore what you do is you sell some ETFs you own with the market index in, and you buy a bear ETF to hedge yourself against the market movements. This, in my mind, is a cheap and easy way to hedge your position. But of course, bear in mind that your long portfolio may not be the mirror image of your short portfolio. So for example, if you decided that you would maintain a long portfolio in a lot of cyclical stocks that you happen to like, there's a recession coming, those cyclicals might underperform the market, and therefore your bear ETF is not going to be the perfect hedge. It may leave you underhedged. But the good news is it'll take you out of most of the risk in the market. So definitely have a look at bear ETFs as well, what the ticker codes are, how to trade them, and at least be ready to do something if necessary. Now, the last strategy, which is very similar, is you can use contracts for difference or spread bets to put on hedges against your long equity position. There are different brokers in the market who sell these contracts for difference, and there are different indexes that you can use as a hedge. These are basically an alternative to the bear market ETF. Either way, if you feel comfortable trading these, and they do need quite a bit of expertise to trade, I'll definitely go through the paper trading first. Then you can try opening accounts to do this and at least having yourself set up so you can put the hedge on when and if it becomes necessary. Either of those four will give you the protection that you need. Big drops in the equity market don't come along every day. They're actually quite rare. But nevertheless, investors are understandably very, very fearful that 30% of their wealth could suddenly get wiped out. You would be right and very reasonable to be afraid of that. So I hope I've given you some comfort that there are measures you can take to firstly reduce those losses if and when it happens, and secondly given you some sense that you should have thresholds, and if the market crosses certain thresholds, then you may want to exit your positions. As ever, the most important thing, have a good process. Think about these issues in advance. Don't wait until the market suddenly is selling off and you're thinking, oh no, what do I do to trade? Make sure you've got the accounts open, the ETFs known, in order to put those hedges on. Don't wait until the last minute. I hope you found this video useful. As ever, click the like button, click the subscribe button if you did, and there will be more videos coming along in the next few weeks.